Hello, everybody. I'm sorry I'm a few minutes late here. I had a little bit of one of those IT issues. Anyways, welcome to this week's Market Huddle. I'm Joe Lucey, and this week, let's talk a little bit about Warren Buffett's annual shareholders letter. This is a letter that Warren Buffett with Berkshire Hathaway, considered probably one of the greatest investors of all time, certainly in our generation. Has done on an annual basis. Most financial professionals take some time out, read the letter, see what Warren Buffett is thinking about the economy and what have you. And while Warren Buffett is optimistic on the economy and things, he did mention some things that I thought made some sense that we spend a little time on this week. So let's talk about what Warren Buffett said in his annual letter, and then we're going to talk about three things I want to make sure everybody's keeping in mind as we look at retirement planning these days. So keep in mind that Warren Buffett used the phrase a bleak future. It's a bleak future. Warren Buffett says if you're retired or nearing retirement, you'll want to make sure that you're paying attention to this week's presentation. Basically, here's right from his letter that Warren Buffett had out. I think it was February 28th. Somebody can probably correct me on that, but it was the last week in February that this got posted. And here's what Warren says. He says that bonds are not the place to be these days. This is a direct quote from his letter to shareholders. Can you believe that the income recently available from a 10-year Treasury bond, that the yield was 0.93% at year end? And had fallen from 94% from 15.8% yield available in September of 1981. I've got a slide here in a little bit. I'll share this with you. In certain large and important countries, such as Germany and Japan, investors actually have earned negative returns on trillions of dollars of sovereign debt. Fixed income investors worldwide, and this is where it gets interesting, whether you're a pension fund, insurance company, or a retiree, face a bleak future. I don't want to try to scare anybody. I don't think that this is a time to completely eliminate bonds from our portfolio, but I do think that maybe we want to start looking at how they play into our retirement planning and start to look at some alternatives, because if you know anything about bonds and interest rates, there's an inverse correlation there. As interest rates go higher, bond prices drop. Now, just since the end of the year, we've gone from a 0.93% yield on the 10-year Treasury. We are now sitting at about 1.6 as we speak today. That is a tremendous move just there in the last 60 to 75 days in the stock market. A lot of this is an indicator that we might be getting into higher inflation. A lot of it has to do with the increases of monetary supply, going back to everything from stimulus package that was the $4 trillion that's already been passed, plus the most recent $2 trillion, and what that could end up doing. And worldwide, they're asking for higher yields from our numbers. So here's a slide that I pulled off here. This is just the 10-year Treasury. This back here, hopefully you can see my mouse, going back to 1980. Oh boy, we got the slide that showed 1995. Actually, if I go back to 1981, you'll see we are at 15%, but we don't have to go back that far. We can just go back to 1995 here, and you can see that interest rates have definitely been trending downward when it comes to 10-year Treasuries. Again, going back to one of the axioms, one of those rules or laws around financial planning, we know that as interest rates rise, the price of our bonds drop. Now, if you are purchasing a bond today and you are buying, let's say, the 10-year Treasury, you're getting 1.6%, there's no safer place than the 10-year Treasury, first of all. So you're going to be pretty much guaranteed 1.6% if the bond is held to maturity. So 10 years from now, you receive coupon payments of 1.6%. You'll get a return of your principal. Where this can hurt us is when we start seeing investors that may start adding bonds. So if we're buying them individually versus buying them in a pooled investment like a mutual fund, mutual funds don't have the luxury of holding bonds until maturity. Think of it like this. Interest rates go up. Your neighbors start looking at the price of their bond mutual fund. When they see the price of that bond mutual fund going down, especially over a few months, they may say, you know what, I'm not so sure I like this bond mutual fund anymore. I'm going to sell it out. So they go and sell out the bond mutual fund. Well, it gets to a point where the bond manager has to continue to redeem these payments that are going out, and sooner or later they have to start selling bonds. So they don't necessarily get the luxury of holding bonds to maturity. But even if they did, we still have to consider these anemic prices we're getting on them. You know, generating income from traditional sources today, CDs, savings accounts, bonds, it's far more challenging than it was even going back, if you look here on the slide, where we were above 7% on those 10-year yields. You know, at those times we were getting 7%. We were probably getting 5% on our CDs. Well, we put $250,000 into a CD today. You're going to be lucky to get about $115 a month. Now, keep in mind that for most of us, those CDs would be taxable, and it doesn't include that. In fact, if we're looking at purchasing a CD, something that's safe, that's going to give us an interest rate for 1 year or 2 year or even going out 5 years, we could safely be losing money. This is a situation where 1%, 2%, 3% doesn't seem like a whole lot. But if we end up in an environment where we start seeing interest rates going higher, you could really be stuck in a rock and a hard place. And that's really what we're trying to avoid here today. So what do I think we can do? Well, I'm going to share with you 2 thoughts on how we can start to protect ourselves. Number one, keep in mind, I'll do 3. I'm coming up with a new one on the fly here. The first one is consider, when you're looking at your portfolios, there's a rule around money management that if you don't like what you're getting in cash, which is earning us near zero right now, there's only 2 ways that we can get a better rate of return. The first is that you have to put the money at risk. So you're going to put it into the stock market. Maybe you can put it into something that's an alternative investment to the stock market, like real estate. Keep in mind, real estate doesn't necessarily follow the S&P 500, but we learned in 2008, 2009 that a lot of families lost money in real estate. So we can put it into an investment, something that is going to expose our principal to risk. The problem is, for a lot of retirees, we don't want all of our money exposed to risk. So where do we go? Right now, you're looking at cash that's paying us 0, or if you tie up the money a little bit, let's buy a 1-year CD, we get 0.5%. Well, 0.5%, we are definitely going to be safely losing money to inflation. So we can start looking out a little bit farther. We buy a 5-year CD. Right now, we're getting a little over 1%. A 5-year fixed annuity, one that pays out like a CD, a fixed amount, might get us closer to 2%. Still not where we were, but a little bit better. So as you start looking at your portfolio, we need to start looking at the trade-off between the amount of money that you need liquid and available that you have to keep in cash and suffer on some returns, or that money that you can put at risk, put it in the stock market or other investments, or maybe we have to look at something where we have to hold it a little bit longer, going into those annuity products or something like that. So one of the things we need to look at is how much of our money do we need right away? How much can we tie up? It's really what a lot of families get when they're visiting with us. When we start sitting down, we start to digest and tailor a portfolio for them. We want to look at how much risk they need to be taking, how much liquidity they need to be taking. A lot of our families, we want to make sure that, I say this almost every week, don't I? Families hire us here at Secured Retirement Financial because, number one, they want to make sure they get the income they need, which is going to bring us to the second point on what we can be doing right now. But we want to focus on mailbox income, money that hits the checkbook each and every month, regardless of what's going on Wall Street. Things like Social Security. Number 2, we want to make sure the money is tax efficient. If I can help families reduce taxes, if our team here can do that for you, if we can save you 20, 30, 40% taxation over the lifetime, that can make a significant difference on the amount of risk and the amount of yield that you need out of your retirement savings. And then families hire us because they want to grow their wealth but never at the compromise of those first two areas, taking back their money and making it tax efficient. So we always keep that in mind. It's a trade-off about putting together a tailored portfolio for your specific situation. But bonds, historically, going back to 1995, this is when a gentleman that I've met, his name is Bill Bang, and he's another certified financial planner out of Sacramento, California, published a study where he had done some research going back to 1926, and he basically said, what is a proper portfolio structure? How much should I put into a portfolio? And after doing a lot of different testing, he came back and published the results of his study, and he said 60% of our money when we get into retirement should be in stocks, 40% should be in bonds, fixed income type products. By doing so, if I take out 4% of this money, he showed that historically we were able to make sure that the money would last at least 30 years. That's where they come up with this 4% rule of thumb many of us have heard. We get our portfolio to a certain point, we can start to take out 4% a year, and we can even adjust it for inflation. The problem with the study that Bill Bengen, B-E-N-G-E-N, that's the way he spells his name, the study that he did is back in those days, in 1995, you can see here, we were getting 7-8% on a 10-year treasury. Well, today we're looking at, anywhere from 1% at the end of the year, 1.6. We start to back test what Bill Bengen had done in 1995, and we see that there's a lot of problems. In fact, that 4% rule of thumb maybe needs to be readjusted down to something closer to 2 or 2.5% rate of return. Well, so how do we protect families that are in retirement? That's what we do here at Secured Retirement. We want to make sure we got a portfolio and start to understand that bonds, we may want to start to limit or reduce some of the exposure from what we had been told back in the 90s from Bill Bengen's studies. Let's also look at how to optimize our mailbox income. Again, mailbox income, money that hits the checkbook each and every month, regardless of what goes on Wall Street. This is different than investment strategies. We're not talking here about whether you should be buying more large companies or small companies or more bonds for that matter, or maybe we should be putting money in real estate. We're not talking asset allocation and diversification here. We're talking about how do we optimize those areas that we have, the money that's going to hit the checkbook each every month, regardless of what goes on Wall Street. And the number one area for most families is going to be around Social Security. I want to make sure that most of families understand that. Keep in mind, Social Security still between our full retirement age, somewhere between 66 and 67 for everybody that's on the Huddle here today. That's your full retirement age. Somewhere between 66 and 67 and the age of 70, you're getting an 8% return in Social Security. Well, let's compare that to other safe sources of income. Those bonds, the 10-year treasury that's earning 1.6, you can see that there's a big delta there. There's a big difference there. It starts to make sense, even though I think it's made sense for a long time to be focusing on Social Security and optimization strategies. Well, it starts with these low interest rates that we're in to make sure that we are focusing on how to get the most out of Social Security. Keep in mind, we've been putting in money into the Social Security Trust Fund each and every paycheck since our very first job. Mine was as a paper route back when I was 12 years old. Every single paycheck, I was putting money into that. When you get to retirement, we got to wring every nickel out of that and get the most out of it. And when we recognize that Social Security is growing at 8% and our safe money in bonds and fixed income and CDs is earning far less than that, we may want to start thinking about optimizing our Social Security. In fact, the Stafford Center for Longevity, this is out of a USA Today article I pulled off, says Social Security is the foundation of a fixed income plan. They're even calling it fixed income here. I think of it more as the paycheck plan, the mailbox income. It's referred to as a near perfect source for retirement income. Again, this is out of Stafford Center of Longevity. And it's guaranteed by the federal government to last your lifetime. They go on and say that filing for Social Security is one of the most important financial decisions of your lifetime because hundreds of thousands of dollars are at stake. If you have not started your Social Security, or you and your spouse, if you're married, if one of you has not, make sure that we are optimizing this benefit for you. We got to get the most out of it, especially in a lower interest rate environment like we're in. Let's use Social Security and that 8% growth. Plus, keep in mind, Only 85% of this is even taxed in the worst case right now. So let's optimize this source of income for you. We can put together turn-by-turn directional guide on exactly how to get the most out of your Social Security. It's not just about waiting until you're 70, and it's usually not about taking it as soon as you can. We want to coordinate benefits between a husband and a wife and make sure that we're getting the most out of this benefit, because it's one of the ways that we can make sure that families' retirements are secure in a low interest rate environment, where Warren Buffett in his annual letter here just said focusing on fixed income is hazardous to a retirement plan. He basically says that it's facing a bleak future. Again, I'm not as pessimistic as Warren Buffett. I still think that there's a place for fixed income, but that 40% blend that a lot of families have, or if you've gone to your advisor and said, give me a real conservative portfolio, you might see 70 or 80% in fixed income. We may want to rethink that, because there might be hidden risks that we aren't aware of. What's the other area? I told you we had 3 areas. The one area is making sure that we're looking at the bonds that are in your portfolio and maybe looking at some alternatives. So what are some other areas that we can use to give us what we're looking for out of bonds, which is some safety of principal and yet a little bit of interest or some return. Number 2 is make sure that we're optimizing mailbox income, money that hits the checkbook each and every month. Things like your Social Security, I didn't mention it here a second ago, but pensions, let's make sure that we're optimizing those. And our team here at Secure Retirement, if you're currently working with us, you know that we put together a blueprint for your income plan. We document it. We want to make sure we know when we're taking that money back. And if you'd like us to review that with you, if you're a client, let's do that. Now is a good time. And if you have not had that done, if you're working with somebody that only looks at investment strategies, the investments themselves, and isn't looking at how to take the money back, schedule a review. I'm going to show you how to do that in just a second, and we can help you with that here at Secured Retirement. What's that last area? Well, it's taxes. Right? I said it earlier, families hire us here at Secure Retirement, number 1, to make sure that they can maintain their lifestyle. They want to know that the money they spend in their 60s isn't going to be money they wish they had back in their 70s or 80s, and they want to live the same lifestyle that they were enjoying before retirement, and in many cases, actually increasing that income. Number 2, they want it to be tax efficient. They want to make sure that they are saving taxes over their lifetime. They want to make sure that they are saving taxes that may pass on to their family someday. That's the second biggest thing that people come to us for. It's really what I enjoy doing. It's my bailiwick. It's my jam. I love helping families reduce their tax footprint. And then the third thing is about growing their wealth and making sure we do that as well, which is about the investment strategies and how do we bring those together. But let's never do that at the compromise of those first 2 areas, protecting the income, reducing taxes. And there probably is not a better time than right now. We are at 40-year lows. 40-year lows when it comes to taxes. And I think that there's a lot of families that are going to wake up here sometime in the next couple years. I mean, we are now after $4 trillion of debt that was added on to with the first rounds of stimulus under President Trump, and now another $2 trillion of additional debt that's been added on. We are pushing $30 trillion of national debt. It's no longer, are we going to see taxes increase? It's how soon do we see them? How do we take and reposition your financial resources? Things like that IRA, the 401k, the 403b, this money that's never been taxed. Now we're talking about, they're talking about increasing capital gains rates. So no longer are we going to pay a 15% capital gains rate at a federal level for that stock that we've had for a long time if we ever sell it. But now they're talking about raising that as high as possibly 40%. We're also seeing them talk about eliminating capital gains step up when we pass on. So now our family, we've been holding on to that Honeywell, that Graco, that 3M stock, that Delta stock. I mean, we're talking about some of the stocks we see in families' portfolios here because they've been in Minnesota. A lot of the companies that we've had here, we got a lot of Fortune 500 companies that have done extremely well. We might be sitting on some stock that is at a very large gain, thinking that, well, we're going to use it. It's kind of a life insurance policy. What passes on to the kids are going to be able to step it up and they won't have to pay tax on it. Guess what? They're talking about changing that. In fact, in today's Wall Street Journal, they were talking about adding wealth tax. Now, that's not going to hurt a lot of our clients because we're talking about getting to a point somewhere between $10 and $50 million where they're going to have to, or where they're talking about, billing you a tax bill just because of your net worth. But that's a slippery slope. Once they start doing that, boy, it's going to take everything away from that 1099 where we've seen where they use to decide how much we're paying in tax to actually asking us to submit balance sheets. So that could be something that I don't think they're going to go that far. But anyways, with that said, keep in mind the IRS doesn't care how much your net worth is. They don't care what's in the 401k, and don't think of that 401k as 100% yours because you still got that partner on there, right? You got a partner on the IRA. You still owe tax on that to the federal government. It's a deferred account. You haven't paid tax on it. What are the tax rates going to be? And the only way to get your arms around that is to put together a look-forward tax plan. 3 things we've been talking about here today. Started off by talking about Warren Buffett's annual letter to shareholders that was released here. I believe it was February 28th. I need to double check my date, but it was right around the end of February here. He comes out every year. The number one investor of our generation, according to many, many people, has said that if you are investing in fixed income, whether you're a pension, an insurance company, or a retiree, he calls out retirees, you face a bleak future. Says maybe we want to start looking away from fixed income or at least reducing some of the exposure. We'd like to help you with the structure of your portfolio so you know what some alternatives are there. Number 2, we want to make sure we're optimizing our income. Let's put together turn-by-turn directional guides on how to take your Social Security so we can optimize that. It's growing at 8% past the age of full retirement at 70. It doesn't mean everybody should wait till you're both 70 either, by the way. But let's optimize that because that's a good way to hedge ourselves against these low interest rates that we're seeing. And finally, taking advantage of the additional money that would be ours if we didn't end up paying tax on it down the road. It's about a look-forward tax plan. I'm not talking about taking an additional deduction to reduce the tax this year. How do we reduce our tax footprint, how much we're going to pay in tax over the next 5 years, 10 years, in an environment which we are going to start seeing rising interest rates, rising tax rates. There's a lot of challenges we have. If you would like to schedule a review, again, this is always open to everybody that's on the call here. If you're an existing client, feel free to use this to schedule on the calendar. But if you are not a client, if you've to get a second opinion, feel free to schedule some time. Let's schedule a 15 to 30 minute phone call anyways, just to talk about your situation and see if it makes sense to start looking at how we do this, what we do here that's kind of special. Put together a portfolio, optimize your mailbox income, and reducing taxes. That's all we have for this week. Let me make sure there aren't any questions before I close out. Again, I'm sorry I started a little bit late this morning, but it is Monday, and here in St. Louis Park, we're starting to see a little snowfall, so hopefully we don't get too much of that. Would an annuity be fixed income according to? No, Warren Buffett would not consider an annuity fixed income, Dave. I think that fixed income, you're really talking about instruments like bonds, CDs. I guess we could probably put cash in that category, but probably more, bonds and such where we put the money in, we get interest, coupons, and then when the money fully matures, we get it back. Treasury inflation protection securities. Yes, Kurt, I think that is an area we can start to look at. There should be some hedging, but keep in mind, even if we are hedging a little bit of inflation there, the problem is, let me go back here. You see, when we were back here and we had interest rates dropping, and remember that relationship I talked about earlier, when interest rates go up, the price of bonds go down. Well, conversely, when interest rates are dropping, the price of the bonds go up. So for the last 30 years, I only went back to 1995. I should have gone all the way back to 1981 where we hit 15.5%. Since 1981, for the last 40 years, we've seen interest rates dropping. That means that if I'm owning a portfolio of bonds, not only am I getting the benefit of the interest rates we're getting, which were much higher, or interest returns, the coupons, but we're also generating some capital gain, some growth. That's going to be changing here, at least according to what I'm seeing with most of the economists that think we have to start seeing rising interest rates. In fact, the bond market's telling us going from 0.93 to 1.6% in such a short period of time. If you're going to hold bonds, I think that there is a place for them. Looking at TIPS, Treasury inflation protected securities. Actually, a 30-year Treasury might make a little bit more sense. It's one of the best hedges against a recession. So bringing in some bonds, I'm not saying to eliminate it altogether, but I'm saying let's start to look at some of the other options there. Let me see, Warren Buffett advice on what we can use. He really does, and he just says to make sure that you're limiting your exposure to bonds. He's calling it more of a challenging environment. In fact, if you Google Warren Buffett letter to shareholders, you can pull this off yourself. It's I think it was about 15 pages this year, and this is on the bottom of page 4. Warren Buffett include insurance as his fixed income discussion. Did not, Jennifer. Really didn't bring up anything about using insurance products as a way to look for fixed income. That's certainly an alternative that you could be exploring. It really comes down to, do we want to put this money into the stock market and risk the principal? But if that's not what the purpose of the money is, if it's really got to be money that's got to be protected, maybe we got to look at some other alternatives or just suffer with low interest rates. Warren Buffett advice he really didn't. He talks a little bit, John, more about some of the other positions he had and such. He doesn't really talk too much about what you can do. But read the letter yourself. I should have probably put a link to it. But if you Google right now, let me see if I can actually do this. Nope. I thought maybe I could share my screen, but I can't. Just if you go and Google Warren Buffett, letter to shareholders 2021, you'll see that a lot of the lines I'm taking were out of the bottom of the 4th page. But he talks about some of the investments that worked for him, some that didn't. I just think it's a good idea to start thinking about this now. I think we're going to hear more and more as we go over the next 4 or 5 years. We're going to start seeing that taxes going up, and there's going to be families that missed an opportunity there. We're going to start seeing families that are wondering why they've got their mutual funds and why they aren't performing in bonds, which they thought were going to be safe because of the rising interest rate environment. And if you are investing in something like a mutual fund, you could potentially get caught on the wrong side, where all of a sudden we have the herd selling their investments, the money manager selling bonds that aren't at maturity that came down in value. And now all of a sudden you get some of these phantom losses, which is where you start paying tax on something that you personally didn't sell that went down in value, like we saw in 2008 was really the last place we saw a lot of this. We'd had a mutual fund. The fund came down. Investors were selling out. The money manager was selling out. You held on to the mutual fund the whole time. It didn't recover, but yet you still got a 1099 at the end of the year for gains because of the stocks that were sold the position. We want to make sure we never get caught in that. Again, use this as a resource. You should have the offer there to go ahead and schedule some time. And I'd love to visit with each and every one of you that are posting comments, and those of you that are looking for some individual time, feel free to do that as well. With that said, I hope everybody has a great week. Hopefully the snow, I think it's only supposed to be just a little bit here. And this is the last of the snow for the year. I shouldn't say that too loud. We still have a hockey tournament and a basketball tournament. I think they're going to be doing some of that. And it seems like we always get hit with that. I'm going to answer one question more here. I'm going to try to. Jim, do you think the current administration will cancel the Trump tax cuts and raise taxes before they set to expire? Jim, I believe... Okay. Whenever I start talking about this, I have no idea what Congress is going to do. So you got to take this with I have no inside scoop here. I do not think, if you were asking me at the end of the year before the inauguration, I thought that there was a 50-50 probability that we were going to see tax rates actually go back or change here as of 2021. I don't think that's going to happen. I think there's too much going on with the pandemic. They wanted to get the this $2 trillion stimulus through and things like that. But boy, I'll tell you, I think they're going to come back to this. Now, are they going to do it next year? They very well could. You know, if it's kind of a slippery slope. If they do it and it upsets too many investors, they could lose the House or the Senate. But if they think they might lose it anyways, well, then they might decide to push it through just to make sure that politics gets in the way of that, but I think it's almost a certainty. I would be very surprised if at the end of 2025 here, that we have not seen changes. Keep in mind that for them, the changes that are already set to be built into the planning, it takes absolutely nothing from Congress to do that. They're already going to expire on December 31st of 2025. And if Congress does nothing, because the tax code that was passed by Donald Trump, the tax act that was passed there, was set to expire sunset here December 31st. So if Congress does nothing, it's going to change. But I do think, Jim, my personal opinion is I think we should be ready for tax rates to go up, possibly even as early as next year, but I really don't know. With that said, folks, I hope everybody has a great rest of your week. And thanks for joining us here on the Market Huddle. And we'll be back next Monday with focusing on something else about retirement planning. Have a great week.